Hello, fellow Rebel Capitals. Hope you're well. So, we've got big news in consumer data today. And of course, the Fed comes out and makes their big announcement on interest rates tomorrow. They're going to have their FOMC meeting. And just a ton of stuff going on right now. Obviously, you know what's going on between Iran and Israel. I'm not a geopolitical expert by any stretch of the imagination. So, I'll leave that up to you guys to get your own news on that. But I want to make sure that we're also remembering what's happening to the American economy. So let's go straight into the Market Watch calendar, because most of you probably don't know that we had retail sales come out today. And to say that it was disappointing is a massive understatement. And they're blaming the collapse in yields, especially the 10-year long end of the curve, on tensions in the Middle East. I don't think so. I think it has much more to do with retail sales and this consumer data just completely tanking. So let's get into it. And then also let's try to think about how this pertains to the next GDP print, which will really impact the Fed's rate decisions over the next, let's say, 6 months or so. All right, let's start with the Market Watch, and we'll go back here to the calendar. So here we got a bunch of data today, and you can see that the retail sales have been plummeting, and the trend is horrible. And last month it was negative 0.1%. They're expecting a negative 0.6%. We got a negative 0.9%. Now, I want you to remember, this is not, I repeat, not adjusted for inflation. So when you adjust for inflation, this number would be way worse. Now, they're attributing the majority of the decline to auto sales, and this is key. This is key. I'll give you a little bit of a teaser right now. You think about what happened with auto sales. Everyone was worried about the tariffs increasing the prices. So what do? They went out and bought vehicles in advance. In other words, you pull demand forward from the future. Okay. Well, this leads us to the next thought experiment, which is, okay, if we're pulling all that demand from the future with vehicles, aren't we going to do that with inventories? Aren't we going to do that with a lot of stuff? So let's get to the specific article here, right here from Market Watch. Shoppers reduce spending at U.S. retailers in May with trade wars dragging on the economy. Really? Like, I'm no fan of the tariffs, as you guys know, from an economic policy standpoint. From a negotiating standpoint, I think they're great. But from a policy standpoint, if that's Trump's intention long term, I think the costs outweigh the benefits. But we'll save that for a separate video. But I don't think a lot of consumers, at least the Americans I know, are making their retail decisions revolving around trade wars. I don't, like the average American, I don't even know if they're paying that much attention to the tariffs. They know that that's part of the news, and they know that that might increase prices. But if they're going out and buying a barbecue because it's a holiday weekend for Father's Day or something like that, I don't think they're going out and saying, oh boy, I'd love to get that barbecue for Dad, but I'm going to hold off until these trade wars settle down. There's no way. There's no way. They're just not that cognizant of what's happening, not just in the domestic economy, but especially when it comes to the international and global economy. Now, that's not a knock on Americans. I'm just saying the average Joe and Jane, they got better things to do than pay attention to all this macro stuff that I get into on a daily basis. So I would not attribute the pullback, the minus 0.9%, to trade wars dragging on the economy or the psyche, the consumption decisions of the average American. I think that's just simply the labor market. That's what's really going to impact. If they're losing their job, if their friends are losing their jobs, if their friends are having a harder time finding a job, Now that's going to impact that decision to buy the barbecue for dad for Father's Day. You might not buy the barbecue. You might buy him the tie or the pair of socks instead, a lot cheaper. So sales at retailers nationwide fell for the second month in a row. The government reported Tuesday receipts tumbled 0.9% in May after a small decline in April based on seasonal adjustments. Okay, chief cause poor sales, fewer automobile purchases. So that goes back to what we were saying. Obviously pulling demand forward. So it seems like a lot of demand was pulled forward. If a lot of demand was pulled forward by the consumer, you'd have to assume that the businesses themselves were doing that with inventories. Therefore, you'd see a big decline in inventories, which could be a huge negative impact or a negative headwind to GDP, which I don't think the market or the Fed is really pricing in right now. I think they're just solely focused on the deficit going down, and that's going to add to GDP. And they're not focusing on, okay, well, inventories will likely go down as well, which would be that drag. Probably a bigger offsetting drag, or potentially a bigger offsetting drag than the increase of GDP due to the deficit shrinking. One key category, however, showed weakness: restaurant sales. Yeah. See, if you guys remember, I've talked about it a few times. I came up with a new indicator, and I used AI to do a lot of back testing and whatnot. And this indicator has multiple inputs, but one of the strongest inputs I saw with all the back testing I did with AI was restaurants. They have a restaurant index, and you had like a 95% hit rate. So when that thing goes negative, you're almost always already in a recession, which for me makes a lot of sense. I mean, if you were going to take an anecdotal evidence from the economy, just one bit of evidence, a data point that would represent kind of how things are going with the average American, I think it's going to be restaurant sales. Here they say people tend to cut back on takeout or go out to eat less. I absolutely think this is probably the first thing they do is go out to eat less. Sales of new vehicles sank 3.5%, and that's that demand pull that we were talking about earlier. Sales at gas stations fell for the fourth month in a row. That's also interesting. I didn't see this before. A good thing for consumers because lower prices. Yeah, so we had lower prices at the pump. Obviously, the prices are going to go up with what's happening in the Middle East. But prior to that, you had lower prices at the pump, yet sales fell. I think that's another thing that is going to be one of the first expenses that people try to minimize: transport and eating out. So here they're trying to blame it on the anxiety for the trade wars. I don't think so. I think this is all about the labor market and the real economy. But that's not all. Let's go back to the calendar. And we've got, let's see, import price index. That was pretty much flat, what you'd expect or what was expected. And then we have industrial production was less, a negative number, negative 0.2%. And then the home builder index, which I think is another proxy for the overall economy, although not as good, nowhere near as good as gas consumption or restaurants. But we've got the home builder confidence index. Expectations were for 35 and we got 32. What I'd like to see is a chart of month over month retail sales. Let me see if we can pull that up really quick, guys. Because my guess is not only have we had now 2 negative months in a row, but my guess is the trend has been going down quite substantially. That's the 1 year. Okay. I mean, it hasn't been great, that's for sure. We had a negative, pretty big. Wow, man. So the retail sales numbers for this year so far have been terrible. I mean, the very first month, you had a negative 1%. Jeez. And again, guys, remember, this is not adjusted for inflation. And then February, a positive 0.12. So basically flat. And then March, you had a surge. And this probably was due to the expectations for tariffs, although that was just before quote unquote Liberation Day. But you had the front running and you had this demand pull from the future. And then you go right down to a negative 0.2. And now we're all the way back down to almost a negative 1%. So if you take out this demand pull from the future due to the expectations for price increases in March, I mean, you're going to have a horrible start of the year. I mean, when you combine all this, you would have a big negative number. And that is in nominal terms. So this is exactly what you would expect when you look at the labor market and the softening there. And then you look at the other data points, such as the restaurant sales. Now let's go over to the Atlanta Fed GDP, because again, I want to circle back to the Fed decision tomorrow. Now, the odds are that they're going to pause. I think there's a very low probability. In fact, let me pull up. What is it, Josh? Is it Fed? Fed. I forgot the CME group there. The CME Fed Fed Watch. Maybe that's it. I just want to see what the probabilities are for tomorrow. It's probably like 100. Yeah, 99.9% that they stay, 0.1% that they drop. Okay, so and then once we zoom out or move into the future, going out to July, 86% that they pause. September, now you're looking at the majority of the market thinks we're going to get the first rate cut in December. Honestly, I don't know what they're waiting for. I mean, we're not having a huge impact to the CPI and to their measurements of inflation due to tariffs or whatever you want to say. I mean, oil, is that going to pass through? Probably maybe a little bit, but not that much. And it's not going to risk accelerating inflation, that's for sure. And you've got all this data that's getting really, really weak, especially in the labor market. And that's the big one. That's what we got to watch for. So if it were me, I don't think the Fed really matters that much, but just based on what the market expects or what the market thinks the power they have, I would be cutting if I'm Jerome Powell. That's for sure. I think he's going to be behind the curve again. I think he raised interest rates too late. I think he's going to be dropping interest rates too late. At least that's how history will likely remember it. But let's go back to GDP now. And we had this big, huge spike. I can't remember why that was, but I remember doing a video where I was saying there's no way. This is 4.6, I think it was. And I went back and looked at the history of real GDP. And there were very few times in the last, call it 30 years, that we had that high of a real GDP. So I was highly skeptical of this number. And since that, of course, it's come back down to where it is today at 3.5. But remember, guys, I don't think I think one of the main reasons they're saying that it's going to be so high is because the deficits dropped, and the deficit is a negative drag on GDP. So I think they're getting hyper focused on that, and they're completely ignoring the fact that the reason we had such a large deficit was people front running and businesses front running the tariffs and the expectation of higher prices. And therefore that's an inventory build, right? So although it was a negative due to the deficit, it's a positive due to the inventory build. And if what we're likely to see now is an inventory decrease, And what would lead us to this conclusion is, number one, the deficits have come down. But number two, we see all of this other demand being pulled forward from the consumer. So why wouldn't businesses be doing the exact same thing with their inventories? So assuming that they are, this means that the inventories are really going to shrink for this next GDP round, which I think would, if we got the number tomorrow, I think the market would be way off sides. This would catch them off guard. And let's go into this calculation so you guys can see what I'm referring to. Components of GDP, personal consumption expenditures. So this is just money that's being spent in the economy. It's pretty straightforward. The net exports, goods and services. This is what I was talking about as far as the deficit. So the bigger the deficit, the bigger the negative drag on GDP. The lower the deficit, the more of a positive it is for that real GDP number. Government spending, unfortunately, this is that adds to GDP. And then you would have business investment. Now, this is divided into two subcomponents. We have fixed investment and change in private inventories. There you go, guys. So I would expect that inventory number to go down substantially, which would offset, or I think probably more than offset, the decline that we'll likely have in the deficit, in the trade deficit itself. Now let's go over to how markets responded and see. When I click on bonds, you can see big down move in the 10-year Treasury today. Call it 7 basis points. And oh, now they're actually attributing it to retail sales. Okay. I mean, literally a half hour ago, I checked on this, and the headline here was attributing it to increased tensions in the Middle East. And now boy, are they watching my video? Maybe CNBC is watching the live stream here because they just changed that. Well, I agree with this, or maybe they agree with me, better said, that this decline, yeah, was all about the retail sales numbers. And I know I beat a dead horse here, but I think it's really important because there's such a narrative that is just assumed. It might not even be a narrative. It's one of those things that everyone thinks is just so blatantly obvious that it shouldn't even be questioned. That interest rates at the long end of the curve are all about supply. You know, the supply of treasuries. So if our deficits are increasing and the debt is going up, well, the supply is increasing. And who's going to buy all of our treasuries? Who's going to buy our debt? It's unsustainable. Why would you even question that? And therefore, if it's unsustainable, nobody's going to buy our debt. We're going to be issuing all these other treasuries because the deficits are going to continue to go higher and higher and higher along with the debt. Then that means that interest rates are going to go up, and regardless of what's happening with the real economy. And in fact, we could have the economy tanking, going into a depression while interest rates are going up the long end of the curve, just like an emerging market. No, I wish that's how it would work, because that would actually put a constraint on government spending. But unfortunately, that's not the way it works with the Treasury market. And the Treasury market moves on growth and inflation expectations, period, end of story. There's a lot of things that go into it, but that's the number one driver, by far, number one driver. And if you need any evidence for that, just, look at a chart, for heaven's sakes. Regardless of the deficits, the debts, everyone dumping the dollar due to the tariffs or uncertainty or blah, 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 whatever you want, we're basically flat for the entire year. Interest rates a year ago were 4.21. Now they're 4.38. And if you want to know what the price moves are doing here, just go back and look at the news headlines. And pretty much this move up is going to be, we're expecting more growth because tariffs aren't as big of a deal as we thought they were going to be. And then this move down, it's just more and more and more of this softening economic data with some noise in the middle there for what's happening in the Middle East. And if I would challenge anybody to look at a long-term chart of the 10-year Treasury yield and try to match that up with the deficits and see if there's a correlation. There's actually an inverse correlation. So all about growth and inflation expectations at the long end of the curve. And that actually, what's happening with the 30-year? I'd really be curious if that moved more. Let's go to, so 6.7 was the move. Yeah, 8.5. Yeah, that's when you really know it's about growth and inflation expectations, when the 30-year goes down more than the 10-year, and the 2-year went down less than the 10-year. Yeah. So in other words, the curve actually got flatter. Let's go back to, and see. We know what happened to bonds. The market was down 300 points, and they're attributing this to Iran. I think this is more about retail sales. Bitcoin was down substantially, almost 4%, 3.5, 3.6, call it. Um, you know what's weird about Bitcoin is it just can't break through this resistance for any period of time. It gets a little over 106 and then it just sell. Like someone's out there, like one of the whales or something like that, that every single time Michael Saylor buys to try to get it up over 106, there's just some huge whale out there that's hitting the bid every single time at 106 that drops it back down to where it can't keep that trend going. It can't continue the breakout. It just has that breakout, false breakout, false breakout, false breakout. So I'm sure it'll happen sometime, but it's really interesting how it's just kind of right at 106. Whenever it gets a little bit above, it's just you get big selling pressure for whatever reason that brings it back down under that longer term resistance level. Oil down slightly today, and then oil up big, but it's not. I mean, most people or a lot of people on FinTwit and the financial media were talking about oil going to 120, 130, maybe even higher. And like we were saying the other day, I think on Friday, my guess is you get this big spike up and then it kind of gradually comes back down after things settle down a little bit in the Middle East. I guess they're not settling down that much, but you're not seeing this huge spike in oil. And I think one of the big reasons is because the oil traders see the economic data softening, therefore demand going down, even if supply is taken offline. I think another reason for this too is that even if you take Iran's supply offline, it doesn't really impact things too much because the other OPEC plus nations can go ahead and just increase their supply, which they probably would love to do right now. So probably not a big, the odds are not high that this, even if this continues for the next few weeks here, hopefully it doesn't, but if it does, and even if it escalates, as long as it's just between Israel and Iran, the likelihood that this has a huge impact on supply is very, very low. So you combine that with the demand side, and I think that's why it's up huge, but it's not, it's not even over 80. It's definitely not at the 110, 120, 130, which a lot of people were predicting. Okay, guys, one thing I wanted to talk about is today's sponsor. They've been sponsoring the channel for the last couple months. They're the great guys and gals over at Monetary Metals. One thing I wanted to point out is, and I know a lot of you realize this that actually have gold in storage, but as the price of gold goes up, your storage fees go up because your storage fees are just simply a percentage of the value of the gold that you have. So think about that. I mean, all of us that own gold, me included, we love it when the price goes up. But when the price goes up, unfortunately, it increases your negative carry, assuming that you're storing that gold and it's not buried in your backyard. And the great thing, of course, about Monetary Metals is there is no storage fee. They actually pay you an interest rate paid in gold on your gold. And what's great is they also take silver. And you can, so if you're someone that likes the gold silver ratio and you've got some gold that's with monetary metals, you can swap that over to silver if you so choose. And then you're getting paid your interest rate in silver. So there's some huge benefits here. And I would, if you have gold on storage, I would strongly suggest giving them a call and seeing what they have to offer. Now, a lot of people get a little confused about their business model because they don't understand the gold leasing program. And it's really about jewelers trying to hedge out their gold inventory, even if it's gold that they have in jewelry itself. So that not necessarily gold bars, but if they have the gold in necklaces or rings, earrings, etc. So it makes a lot of sense why the jewelers would want to hedge out their risk in the gold price going up or down. And monetary metals gives them the platform to do this. So they're just basically taking the jewelers who want to hedge out their inventory risk, and then the people who actually own the physical precious metals, and then they're just merging them together. And so it's a really neat concept. They've been doing it for 8 years. I've got an account with them, and I've got about $45,000 of gold in there right now. Definitely not all the gold that I have, but I wanted to try it out because they were going to sponsor these videos. And so far, it's gone great. The user interface is awesome. The customer service is fantastic. So if you have gold, if you're looking for an opportunity to get paid an interest rate in gold, as storage fees continue to go higher, definitely check out monetary-metals.com/gammon. And if you want to learn more about their business model and how it works, Josh will put a link to an explainer video that I did. But after watching that, write down your questions, give them a call, and the customer service people will be more than happy to answer your questions for you and see if it's a good fit. All right, guys, enjoy the rest of your afternoon. As always, make sure you're standing up for freedom, liberty, free market, capitalism. We'll see you in the next video.